Hey, Shane, how's it going?
Hey man, I'm good. I'm trying to fire up my stopwatch so we can rip through this thing quickly and stay on task today because we got 30 some slides. And we're not going to be able to spend much more than a minute on each one. So I'm trying to get my stopwatch dialed up here.
Sounds good. Well, we'll get to it. So, for those tuning in, it is April 20th, and yeah,
Happy 420 to all you pot smokers out there.
yep. So we'll get into it, but all right, Shane, real quick, just hitting on this chart we've looked at before, but you can see a bear market where you get the rally. We're assured everything's okay. It's not. Um, from there, 2008 went down another 43%. So that's
Yeah,
possible.
I added the little screenshot there of back in 2008, April 10th, when Bernanke was saying we could be facing a mild recession, and we'll get to a slide in the deck here a little bit later that references that. So just make note of that. April 10th, when Bernanke said the U.S. could be facing a mild recession, and about 6 days ago we heard something pretty similar again. So it's getting eerie.
That it is. So, Shane, I wanted to kick it off with I'm going to present the bullish case here. So, I know you and I sometimes we can disagree on time frame and what have you, and but I think it's good too to just see the bullish case. And you'll notice it's going to be technical in nature because the fundamentals don't look good. So, that's what it is, but sometimes price can diverge from fundamentals. If you look at the different sectors, the 200-day right now, broadly speaking, most sectors are above the 50-day or the 200-day. They're also above the 50. What I will point out though is, information tech really leading it there, and I think that's no surprise given just how beat up that sector got. So, you would expect that. And then the other one here is, utilities. That's a defensive sector, not one I really want to see leading. So we'll see what's in store, but right now, broadly, the market breadth, pretty good. So from a technical standpoint, I'm noticing that, but I know we still have a key level to watch. This is the other one I'm looking at. So CNBC put this out end of Q1. They surveyed, asset managers and some pretty large funds out there, 400 of which kind of weighed in, and 68% are still positioned short. So I see that, and sometimes in trading or markets, you try to be a contrarian, and that to me sometimes can signal, hey, maybe this is a time to get in and buy some stuff if everybody is that negative. So Shane, any
Good
thoughts
luck with
on that?
that. Yeah, good luck. I think you're gonna need it.
Yep. And that's where, so I want to hit on one key thing when we go to the chart. This orange line is the thing that stops all of that if we're talking technicals. And we need to see the SPY close over 420 or ES 4200. That is the level. We've been sideways for over a year now at that level. If we break above that, technically, then you kind of see that we are breaking up. But right now, you just have breath within a sideways market. So the conviction's not there. I'll say that. Now we have earnings season, so I anticipate that earnings season will keep us right in here, and then as that kind of provides some certainty in the market, you could see us perhaps move higher or could be lower. So we'll see.
We will definitely see. We always do.
And Shane, I know you like the MACD, and right here you can see that too, is that positive momentum is starting to wane a little bit. So that could be a early signal or clue of
Yeah, we're
what's going to happen here.
at the top end of the range with declining momentum. That's usually a good opportunity to start getting short. I just, even if it only goes back down to the bottom of the range around 380, I think there's still some good money to be made on the short side there. And um, we'll see what happens with earnings season, but I don't think it's off to a great start. The big banks have reported, and so that's skewing earnings to the positive side. But once the smaller banks report, reality, I think it's not going to be quite as good. So the S&P 500 earnings look okay right now, mostly because JP Morgan, and JP Morgan was like one of the only banks that benefited from the banking crisis situation. So I think all the rest of the banks did not benefit. And so I don't know. Doesn't look good. Should have our second straight quarter of declining S&P 500 earnings. So the earnings recession is well underway. I think GDP is slowing. Inflation is slowing. By the way, as inflation goes down, that means revenue goes down for the S&P 500 companies, right? It doesn't grow
Hmm.
as fast. That's why you see companies like Tesla, which we'll get to that chart, dropping prices uh, pretty much like weekly, it feels like. I think they've done 6 price decreases already this year, and they're not making it up on volume. So yeah, I don't know. I think the bear market rallies can go much further than people expect, and they tend to cause FOMO and people to worry and say, "Oh, I'm missing it. The market's going up without me. Let me chase this." And usually, everybody does that at the exact wrong time. So I'm committed to following the fundamentals here, and um, it's not like we're 100% short or 100% cash. We got some longs in the book too, but I think cautious is still the way to be.
I agree. And then here's your count right now. So we are now at 16 days of the SPY 200-day moving positive. So Shane, how many days does that leave us with?
I'm not very good at math, but I think 16 plus 5 will get us to the 21 days. So we got 5 more days, and honestly, the market's going to have to drop pretty hard, pretty quick for that to stop going up for the next 5 days. So
Hmm.
I think I think by one measure, people could argue that the market is back in an uptrend just based on this. We'll see what happens over the next 5 days. We should have, I guess, next time we do this call, Thursday the 27th, um, we'll know whether or not it stuck. Again, that isn't like some signal where you want to go out and put all your account long the stock market.
Yeah.
It's just one indicator that goes in the bag of bullish technicals,
Yep.
and the technicals are pretty bullish. Hard to argue with that. It's the fundamentals that are not bullish at all.
I agree. And looking at NASDAQ, this one, it looks like we're above this kind of 313 level. So we have cleared some of that resistance, but not definitively. And you're seeing MACD start to go negative here. I think this one too, it's hard with earnings season here. I think that's going to be the catalyst that really pushes us one way or another. So you don't want to predict that, more so just react from that. So I think that'll probably push, either the NASDAQ or the S&P, both of those I think will probably get pushed from earnings in one direction or another. So
Yeah, and that yellow line, that 313.74, is nothing special. It's just where the market closed 2020. So market closed at 313.74 in 2020. It went all the way up here, to call it 400 at the end of 2021. And now it's all the way back to where it started 2020. So, if you had bought the NASDAQ on January 1st of 2021 and held it all the way to today, you would be flat for the past 2+ years, right?
mhm.
2 years and 4 months, you'd be basically flat. So that is kind of a long time to have the growth tech stocks do absolutely nothing. Um, I mean, it's not like there wasn't some volatility in the interim. It went up a lot, and then down here you were down a lot um, at the lows last year. And as of today, you're basically flat if you had bought the index and held it from January of 2021. So pretty crazy that that's where we are. But you can see the market has reacted to that level more than once. I mean, here it reacted to it, here, 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 of course, and now we're sitting there again. So we'll see which way it breaks. We already have some negative momentum on the MACD here, so that honestly leads me to believe that it might break higher from here, and that would be interesting. But time will tell, so we'll keep an eye on it.
Yep, we'll see. So hopefully next week we'll have a decision on what way it's going to go. And same thing, 200-day count. We're at 20 days on this one, so it almost seems like it's in the cards that it will break that, 21-day count. So
Yep.
again, not a definitive indicator, but the trend is your friend, of course, until it ends, and that gives you an indication of long-term trend, and looks like trend could be higher. And then Schwab, Shane, this has been our one we're watching. We even picked some up, and look at that. Didn't quite get all the way down to that 45 level. I think that's still a smart place to have a stop, but uh,
Yep.
tell us what your thoughts are there.
I just think that Schwab is not a bank, and it's getting sold with all the banks because of bank failures and bank runs. And Schwab is not at risk of that. In fact, Schwab, just like J.P. Morgan, benefits from it. They get all the money when people go fleeing from their small regional banks and need somewhere to put the money. Just yesterday, I think it was our my partner Ken, the CEO, I guess, of Elevate said it's T-bill day. I just finished my fourth call from people wanting to move money out of their bank and into U.S. Treasuries at Schwab. So this is just, I mean, it's still happening. Granted, that's a small sample size, but we're seeing it with our client base. And I think it's happening across the board, which is why Schwab reported a good number. They had earnings out a few days ago, and it's done nothing but go up since. And so I think now that we are on the other side of earnings, I think now is the time to maybe add to that position if you took advantage of this massive drop. And I mean, it doesn't have to go to a new all-time high to make money here. I mean, if it can go from 56 to 72 running into the 200-day moving average, and I mean, that's a pretty strong return for a short-term trade in a blue chip company that's been around for eons, it seems like. So uh, I think this is just a safe trade that you can get in. You can still get into it, and I think it's a good play.
Yeah. And something I'm looking at right now, you have that short-term relief bounce, but then right up here around 60, I think that's going to be your next level of resistance. And if it clears that, comes back for a little retest, that is all systems go, in my opinion. That's where you could see it really start to get some momentum on the upside.
Yeah, and I haven't read through their earnings release yet. I mean, it's a 160 page, document when they file it, so I haven't gotten through it all. I do have that on my list, but haven't gotten to it yet. So we'll see if there's anything good in there. But I'm just not as worried about Schwab as I would be about a smaller regional bank. But this thing got sold just like all the rest of them, so I think it's a good opportunity.
Yep. And then looking at the 10-year treasury, so it's still kind of doing what we've been talking about. It does look bullish, like rates might go higher, but it's likely to just churn around for a while. And I think that's all you're seeing here. Just a little more kind of chop taking place until it builds up some footing.
Yeah, I don't know. I think it's probably done. I think it's going to go sideways here for a bit between the 50-day and that recent low, maybe 3.291. Maybe bounce around and kind of find a direction. But I think the 10-year yield going down is not bullish. I think people see that growth is slowing and they want to buy this 10-year bond. I don't think that's necessarily a good reason to go buy the Nasdaq, which has been the case for the past year or so. And that's what we're seeing happen. I think people will be disappointed in the long run on that, but time will tell. And yeah, I think the 50-day moving average here on the 10-year yield holds for now.
Yep, I agree with you. And then 2-year, kind of the same story here. We've had this, big move up through the year, and then now I think it's likely to just chop, be range bound, looks like between about 3.6, maybe 5%.
Yeah, and the 2 years a better proxy for what the Fed is going to do with interest rates, and so the 10-year yield is not exactly that. That's more of a long-term thing. So um, as we can see, the 2-year yield is still higher than the 10-year yield. We'll see them compared on the next chart, and I don't know. The yield curve has not uninverted itself, and even when it does, I think that's more of a signal that we're just a little closer to the next recession. And whether the next recession happens, in the next quarter or early in 2024 even, I don't really know. It's taken a lot longer than I expected, even though we did have two back-to-back quarters of negative GDP last year. That, in my book was the beginning of the recession. Nobody wanted to call it that. So technically, you know, they're not saying we're in a recession, but I think we probably are.
Yeah. And I always think it's important to highlight that, recessions and market bottoms don't line up perfectly in time. So, you try to forecast one and then there's a little bit of a lag or leading, timeline in there. So we'll see how it all comes together. But I think everyone seems to be on the same page with recession is either already here or coming very soon. So we'll see. And then here's kind of the difference between tens and twos. Shane, if you want to talk about this one a little bit.
Yeah, I mean, it just the two charted together. You can see when the yield curve first inverted or the spread first inverted, and then it bounced a little bit, and then it did it again back in July. And we have been in a negative yield curve environment where short-term rates are higher than long-term rates for almost a full year now. So no surprise that banks are having trouble making money. They need the yield curve to be positive to make money in their principal operating business. And even though we got a little pop more of a steepening move during the bank crisis in the middle of March. It has so far failed, and now we're at our lowest levels of the tens minus twos since the banking crisis unfolded. So we were at minus 64 basis points. Anything negative is not good for banks. And the yield curve tends to, after staying inverted for a while, it tends to then steepen before a recession begins. So, that's what we're looking for to have happen again. I don't think this time is different. This time is unique, just like all the times are unique. So history doesn't repeat exactly, but it often rhymes, and I would bet that we are either in or heading into a recession based on the inverted yield curve and the negative tens minus two spread.
Yep. And then speaking of recession, oil, that's been one where recession has been a topic that comes up when you talk about the price action. And so we had this gap up from 76 to 80, and that was OPEC announcing their, cut in production. And you thought we're off to the races. It hit the 200-day moving average, has since failed. Looks like it's filling that gap. And I I don't know all the fundamentals on oil, but if the price action's doing what it is now, which is telling me it wants to go lower, maybe that is signs of a recession, lower demand in oil, because we don't hear a whole lot about a ton of new oil coming to market. So maybe that's something to look at, but definitely looking pretty bearish right here. What are your thoughts?
Yeah, I don't really think we need any new oil to come to market. We're never going to run out of oil ever, 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 ever. I don't care how long the world lasts. We'll never run out of oil. The whole peak oil thing was such a joke. We don't need electric vehicles because we're running out of oil. Like it's all nonsense. And these spikes in oil price due to OPEC actions are always short-lived. I mean, I'm talking about always. Um, you knew this was going to retrace the moment that it came out, and it's super tradable. Like you just keep trying to short it until it finally breaks down because the reason that the Saudis OPEC cut production was because demand is dying. Like there is a lot less demand for the oil. So in order to keep the price up, they cut production to kind of equalize the market and make the price go up. But the truth is that it doesn't matter. Demand's crashing, and there's nothing they can really do about it. So like if you look back through history, every time you get one of these headlines, you short it. Maybe not immediately. You wait for it to start going down and then you short it, right? Because it stayed high for a few days and then popped up to the right into the 200-day moving average, and then from there, boom, it's a sell. If it breaks through this purple trend line here, it's going to be a bigger sell because there's nothing stopping it at that point. It breaks through the 50 and the trend line at the same time. 70 is the next stop and can go all the way, back down to the recent lows too, easily.
Yep,
So I just think from technical and fundamental perspective, oil is probably going to go lower, before it goes higher someday. And yeah, I don't know. I don't trade oil, but we're still long XLE. And the oil producers continue to perform. They continue to look very cheap relative to the rest of the market and relative to their own history. And they're growing revenue quickly, despite the fact that demand is down. So I think the green army of the electric vehicle people have effectively created a good profitability situation for the oil producers because they don't have to explore as much anymore, so they don't have to invest money in all of that exploration. They're just able to keep doing what they do, and it's kind of interesting. So interesting dynamic.
it is. And I'll just highlight one point based on what you were saying. Buy the rumor and sell the news. As the biggest thing you need to know in the markets is when you have OPEC come out and make an announcement, Usually it maybe gives you that pop for just a little bit and then it all goes away because everyone was betting on that. They got in down here. So always a good point to remember when that big announcement comes. Usually that's not going to be the catalyst that takes you to the moon. It's usually getting in before that. So, and then just looking at mortgages, kind of consistent with what we were talking about in the 10-year, some sideways action. We're seeing that here where now we are sitting about 6.25 on the 30-year, and we're probably just going to move sideways. I think that's a normal rate. I think 5% kind of a historical norm. So no surprises there.
Nope, nothing to add.
What about this one? Shane, you brought this in. David's Bridal declares bankruptcy. A lot of brides either are not shopping there or maybe there's something else going on there. What do you got?
Yeah, well, I mean, there was like a, when the government shut the world down because of a flu virus or whatever, lots of people called off their weddings because, heaven forbid everybody get together and celebrate the coming together of a man and a woman in marriage. Can't do that. Everybody might die. Can't be in close proximity to each other. Certainly not in a church. Can't. No way. Couldn't. The government can't allow things like that.
Hmm.
And so you had a lot of people who, didn't get married during that time. And so coming out of that, when they finally, opened the world back up and said, okay, we were wrong. I wish they would have said we were wrong. But you can gather again. The people can gather again. So you had this like mass rush of new weddings happening for a while, and that has effectively, ceased. Everybody who wanted to get married got married, and it's back to normal. And I think this is the second time David's Bridal has actually gone bankrupt, believe it or not. I think this happened already, maybe 5-6 years ago. They went bankrupt once and then came out of bankruptcy. I could be wrong, but I feel like I remember that happening. And then another one like the same day. This was just 2 days ago, I think, that I created this slide. But then you get this company, U.S. Auto Sales. They temporarily close all their dealerships because I think Capital One, who was their lender, just like pulled the rug out on them and were like, "Hey, we're not going to do any of your." It's called floor planning, and it has to do with how dealers stock their dealerships and how many cars are where and all that kind of thing.
Hmm.
And they need a financing partner. I don't fully understand it, so forgive me if I'm like butchering this, but ultimately Capital One said, you know what, we're getting out of that business. We're not doing it anymore. And so this dealership lost their partner, and they basically sent an email to their employees. Was it might have been yesterday morning or maybe Tuesday morning. And they were just like, hey, y'all can go home. Might as well clock out. We don't have anything going on for the next couple of days. And I think today's Thursday. I think I called them. I actually called one of the dealerships because they're local here. And I was like, hey, somebody answered the phone. And I was like, oh, well, I was just calling to see if you guys were open. And she said, yeah, we're closed until Thursday, but we should be reopened on Thursday. And I just pulled up the website, and they still have that message there, so they're still closed, and they're probably just going to go bankrupt. I mean, that's probably they're probably going to shut down.
Interesting. And that's
So
that's what happens when you have the cost of credit goes up, which that's a good natural thing. You need to
mhm.
have, a barrier where you can't just throw capital at anything. You need to be selective. So,
But the technicals, Kyle, you should buy stocks here because the technicals are good and the market's going up. So the market's gonna keep going up because it's going up, right?
sometimes
No,
sometimes you can have a disconnect, but like
this
I
is what's
said,
going on under the hood.
yep, like I said, we need to clear that resistance level to give any kind of definitive marker on that. So, to be determined, but like you said, fundamentals still obviously are pointing bearish. So,
They're terrible. It's
yeah,
it's terrible out there.
yeah. And here's our, crystal balls, people at the helm that know it all, finally giving us this mild recession might happen.
I
So,
like the I like the picture of Bernanke praying, because he was literally praying that the recession would be mild back in 2008. Do you guys remember April of 2008? Yeah, that was right after Lehman, or excuse me, right after Bear got bought for $2 a share by JP Morgan, like we looked at in the first slide. And right before Lehman failed and Countrywide failed and Bank of America bought Countrywide at way too high of a price. And we entered the great financial crisis with millions homeless, um, and the market crashing, by 50%, pretty much immediately after this guy came out and said we'd be facing a mild recession. And of course, 6 days ago, a mild recession is now likely this year, says the Federal Reserve. Bernanke, by the way, was the head of he was the Federal Reserve chairman, said mild recession. And now we get the Federal Reserve saying mild recession. You can't make this stuff up, man. I mean, they have a script. It's the same every single time. And we looked at a slide not too long ago where Janet Yellen was saying something about the banking system being sound, just like Hank Paulson was saying at this time in 2008. Our financial institutions are strong and the banking system is sound. Like, it's eerily similar. I mean, it's eerily like the Big Short famously talks about everybody walking around like they're in an Enya video, like everything's fine. Like they don't care about US auto sales failing. They care about what Kim Kardashian had for breakfast, or, they care about which movie star is just getting out of rehab. But nobody cares about this stuff. It's like, oh, it'll be fine. The banks will be
Hmm.
fine. Everything will be fine. This will all blow over. They bailed them out. It's all good. Like, now it just takes time to work through the system before we see the next crack form. And yeah, the market can rally in the interim, but when reality finally sinks in, it takes, it jumps out the window on the way down. It takes the stairs up and then jumps right out the window. And so that's what I am concerned about. That's what's on my mind. My job is to protect people's nest eggs and take risk when the odds are in our favor. And I just don't see the odds in our favor right now of taking a bunch of risk with other people's money, or my own for that matter. Um, yeah, we have some longs. We're long some Hershey and some Coca-Cola and some Costco and some Apple and some things that are tried and true and large blue chips. But I don't think now is the time to be going long the ARK Innovation Fund or Tesla stock, or any of that crazy stuff. I think now is a good time to stay away from that stuff.
I agree. So, yeah, and look at this one. Historical bear markets that we've seen and bull markets, it looks like. 2022 to be decided on right now, but looking like down 25% right now for the low.
Yeah, so here's the big takeaway is, on average, a bear market drops 41% over the course of 20 months. So far, this current bear market, to the lows from when it started in January 22 to the lows in October, was down 25% over 9 months. So that's about half of the time that a normal bear market lasts, and about half of the drop that a normal bear market experiences. So, averages don't mean anything. It's just an average. But this is a below average bear market with way above average debt heading into it, and I think way above average issues heading into it. And so I would expect that this bear market, when it's all said and done, drops more than 41%, and it takes longer than 20 months. Um, so time will tell, just like everything else. But I don't think this bear market is over.
Yep. And I think that's a good point to, bring up is 9 months relative to historical norms. That's a very quick recovery and it makes you pretty skeptical.
Yeah, and by the way, I don't know if you know this, but I know you listen to Macro Voices.
Hmm.
Maybe Kyle can put a link to Macro Voices in the show notes here. Um, but David Rosenberg was on. I got the headline email that comes out on Thursdays, and he says the headline is "The Bear Market Bottom is Not In," says David Rosenberg. So I don't know if you probably have not listened to that yet, Kyle, but
Not
that's
that
what's
one
out
yet,
there
but
for you.
yeah, that's a great podcast. And I'd encourage anyone that really wants to get into the big moving parts in the world. That's a great podcast to check out. So,
I just sent him a reminder to post the link in the show notes.
and then here's we go. So here's the trend in GDP growth. And right now, a little bit under it. Anything to
Yeah,
add there, Shane?
well, current chairman of the Federal Reserve, Mr. Powell, says that we will require a sustained period of below trend growth. So they're looking at a sustained period of below trend growth for GDP. And here's the thing, GDP growth is slowing. It was 3.7 in Q1 of 22, down to 1.8, down to 1.9, down to 0.9 in Q4. I think it's going to go even lower for Q1 of 2023. So I think this is going down. Well, it's obviously going down. I think it's going to continue trending lower, and slowing GDP is telltale signs of a recession. By the way, in Q1 and Q2 of 2022, this was 2 consecutive quarters of declining GDP. That's generally the definition of a recession, except for, like I said before, they just didn't want to call that one a recession this time.
Yep.
So I think the recession started all the way, well, I guess all the way back here in Q2 of 2022. And I think we're still in that recession. And I think it will only deepen and worsen as time goes on, until someday it gets better. Like, I don't think the world's going to end, but I think we got a lot lower that we should go in this recession. So we'll see.
Yep. And it's all part of the business cycle. So it's not, all that unusual, but here we are. We talk about debt and delinquencies are on the rise. So that is definitely something to pay attention to.
Yep, people are more than 30 days behind on their auto and their credit cards. Shocker. With people, more people than ever having over $1,000 a month payment for their vehicle, and credit card balances at all-time highs with all-time high interest rates on those balances. It's really no surprise that people are delinquent. Those will move from 30 days delinquent to 60 days delinquent, then to 90 days delinquent, and then they'll be written off, and those people will have to file for bankruptcy, and that happens during a recession. So see the spikes all the way up here, back in 2008, 2009. Well, it didn't start that way, right? It started here and ticked all the way up there, and now we're way down here. But I think we could easily get back to the 14% area on those, and that's not going to be good for the economy. It's certainly not going to be good for the stock market.
Nope. And then the personal savings rate, just kind of the other shoe to drop when you talk about credit card delinquencies. But it looks like savings rate. Actually, Shane, am I reading that right? Does it look like savings rate ticked up a little bit?
Yeah, ticked up a little bit so this is 2020, this is 21, this is 22, this is 23. So has ticked up a little bit, but way below the average. And you see, it got awful low down here in 2005. It took a couple of years before the great financial crisis actually happened, and you can see the savings rate was ticking up into the great financial crisis. So the fact that it's ticking up, I don't think really is that big of a deal. I think the fact that it is at 4.5%, which is roughly half the normal rate, I think that's more of an important thing. And of course you can see here, like I was saying, people have more revolving credit than ever before in history. So $1.2 trillion just sitting around in credit card balances, higher than ever before. So more people have more to lose than ever. And when people don't pay that money back, the credit card companies are the ones who take it on the chin. I mean, certainly the people who don't pay it back getting to file bankruptcy is no fun either. Would never want to have that happen, but it is going to have an impact on the economy as those delinquency rates continue to tick up on more debt than has ever been seen in the history of the world.
Yep.
Just too much debt out there, man.
Yeah. And then this one I think is really important. I'm glad you brought it up is nominal versus real yields. So nominal is just face value. So right now I can go get what 4.5% return on short-term money.
Yep.
But the real rate of return is if inflation is higher than that. So let's go with if I'm getting 4.5% and inflation is at, let's just say 8. That means that I'm actually still losing 3.5% every quarter or year, I guess. But I'm earning some. So that's important to look at is real versus nominal. And
Yeah.
looks like right now we're earning negative 2% real yields. So people are not increasing their wealth by buying a 10-year treasury.
That's right. Going backwards, having purchasing power eroded. So yeah, you can invest and earn 3.5%, but if inflation is higher than 3.5%, you're still going backwards. You're just not going backwards by as fast as if you left it earning zero.
Yep.
So negative real interest rates are bad. Um, Ask anybody who lived through the economy and the markets of, the 70s, where just the the recession that would never end just kept going on and inflation was crazy high. It's a very similar situation to now, and that took a decade to figure itself out. So everybody who wants this bear market to be over in 9 months, I think is just, I think that's wishful thinking. It's possible. Anything's possible, but I don't think it's very likely that we're going to get out of this, after a 9 month and 25% drawdown. I think there's more to come.
Yep. And then here's just a kind of a heat map, I guess, of worldwide inflation. So,
Yeah, around the world. And so if it's not obvious, red is bad. Red is not good. And you see not a lot of red for most of the time, and right now, a ton of red. 2022 especially red, 2023 even uglier red, pretty much across the board. So everywhere else in the world is also experiencing this high inflation, and it is devastating economies all around the globe. The one major outlier is the second largest economy in the world, China. And China actually looks pretty darn good. We say they're in quad one. They actually have declining inflation, so slowing inflation and growing GDP. Um, and they are in a much better position than the rest of the world, despite the fact that Janet Yellen was out giving a speech today on how, China's bad for everybody. And I don't know, it was an interesting posture for the United States to take against China. So if you haven't heard about it yet or read any articles or watched her speech today, you can go look for Janet Yellen's speech on China. I'm sure if you just type that into the old Google machine, you'll find it. Um, she's hard to listen to, so if you need a nap, I suggest pulling that up. It'll probably put you to sleep in about 10 seconds. But it was pretty interesting if you listen to the words and you can make it through without falling asleep.
yep. And then Shane, I kind of mentioned it before, but just the narrow leadership we're seeing right now looks like you found a chart representing just as much for Apple. So I don't know if you want to talk to that.
Yeah, I think it's more the next page that'll share that. I think this is just a little interesting. That's not so much the narrow. I don't think this really is about the narrow leadership so much as it is about the lack of diversification in the S&P 500 index right now. So a lot of people just like say, "Oh, I'm going to passively buy the SPY, the S&P 500 index because it's diversified and 500 companies and blah 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 blah." Well, you're getting 7.1% of your money is just going into Apple. So that's the biggest chunk in history for the S&P 500 in any one company. Doesn't mean that Apple's gonna, you know, get killed. I mean, look at how many times Apple is on the list here, going back to 2010 when it took the title from ExxonMobil. I mean, it's constantly there. Microsoft used to get the title, and Microsoft certainly hasn't gone bankrupt. Microsoft was all the way back here, right? Several times. So I don't think this is really indicative of like, oh, this company is bad or you have to be afraid of this company or anything like that. I think it's more indicative of just like how little the lack of diversification in the S&P 500. It's not as diversified as people like to think it is.
Hmm.
And when Apple reports earnings, let's see, when is that? It's coming up soon. Apple will report on May 4th. If they report, slowing iPhone growth and give poor guidance for the rest of the year, like a lot of the technology companies that have reported so far this year or this earnings season have done, if Apple were to be down, 5% or 10% in one day on poor earnings, which someday will happen, I guarantee you, whether it's this quarter or not, I have no idea. But if it's down 10%, well, that's going to take the index, like the rest of the stocks in the index would have to go up a lot in order to make up for one really bad day in Apple. So as goes Apple, so goes the S&P 500, and I think it's just something that you have to understand and know about. That is an all-time high, and I think it is likely that it'll represent a lower percentage at some point in the future. So that will happen when the stock goes down. Anyway, I just don't think the S&P 500 is diversified as a lot of people want to believe it is.
Yep. And then just another one, like you said, highlighting the narrow leadership we're seeing right now. Right, pretty low percentage of stocks outperforming. So I think that's something definitely to take note of.
Yeah, fewer than 32% of stocks are up more than the index itself. So, you would think that that would be closer to 50%. This is actually one of the lowest amounts since 1928, and the most recent precedent was 1999, of course, marked here by the red arrow, and you can see what happened after that. It went up for a little while. I don't know if you can tell, but from that red arrow to say here, right? There was a little bit of an uptick, and then kaboom, things went down during the dot-com bubble. And so we're back at those levels again. And it hasn't historically been a great indicator. There's no magic bullets out there, so this isn't like everybody has to go short the market because this indicator came in this way. Sometimes it just doesn't matter. But sometimes it does, and the one time that it does, you're definitely going to want to be paying attention. So just something to keep your eye on. But yeah, historically, every time it gets down here, it doesn't necessarily mean that a major bear market's right around the corner. But for this to happen already in the midst of a bear market, I think is interesting.
Hmm. And then here's our FOMC members. We got the Beige Book data recently. Shane, if you want to talk to this one.
And it's just yesterday that this came out, and so I've kind of made bold the most important parts of the statement. So additional policy firming, that means rate hikes. That's what that means. That means more rate hikes and more quantitative tightening through reducing the size of the balance sheet. Um, so there and attain a sufficiently restrictive policy stance means it has not yet been attained, right? So rates at 5% isn't restrictive enough. So they're going to hike rates again. I mean, that's basically what they're saying is when the Fed meets early in May. I think we have one more of these Elevate chats between now and then, but they're probably going to raise rates again in May, which is one more than what I had originally priced in when I started looking at this, late in 2022. And then they went on to say the collapse of two regional banks will likely tip the economy into recession later this year. So now the Fed is admitting that we will likely be in a recession later this year. Of course, we saw the slide that said that they think that will be a mild recession, just
Hmm.
like Bernanke thought back in 2008. So they got the optimism punch bowl full over there, I think. And it's just very obvious to me that we're heading into a recession if we're not already in one, and that recession has no business being called mild. I think it could easily be one of the worst we've seen in a very long time with the amount of debt that we see compared to even the great financial crisis. There's just so much more that can go wrong when you have that much leverage in an economy, and the only way out of it is to print money. And printing money will, of course, reaccelerate inflation and get us right back to where we started. So I continue to think that our economy is just in a very tough spot, and the best thing to do is kind of rip the band-aid off and feel the pain, so that we can begin the process of healing sooner. So that's my personal view, and we'll see if it comes to pass.
Yep. And then turning to some better stuff here, we have Babylon B, some newlyweds looking for a place to live. Sad but true, it seems like trying to buy a place anymore.
Man, I would not want to live in San Francisco. I can't even imagine what it's like to go house shopping there with rates being what they are and prices being what they are. Like I do okay, but I don't think I could afford even a bathroom there. So they
Yeah.
got a zero bath starter tent. Is probably where I'd be looking. I don't think my wife would like that idea too much. Although she
Yeah.
does like to camp, I don't know that she'd want to do it permanently.
Yep. And then here's a good one from Hedge Eye. Um, and liquidity is a big issue here because when you're indexing passively, it's easy to go along, but if that liquidity dries up, it takes one big player to get out of a position that can really move the market. So it's a good one there.
Yeah, and I think the Kevin thing is a play on this guy named Meet Kevin, who's like some
Yep.
some I don't know, some social media influencer stock trader that they created ETFs based on, and like just in time for them to crash. So yeah, go check out Meet Kevin and do the opposite of what's going on there. And I think that guy's long the technicals, so be careful about being long the technicals.
Yep. So perfect. Well, Shane, it's been a pleasure. Thanks for taking the time, and I'll see you again next week.
All right, man. Sounds good. See ya.
Yeah, have a good one.